Hello, everyone, and welcome to our webinar today about attracting great talent to your startup and understanding EMI option plans. Do take advantage of the QR code on your screen right now. It's regarding the startup manual filled with lots of useful information for your startup. My name is Jay. I am a senior legal consultant here at LegalVision, and you're in great hands today as I am joined by my colleague Michaela, who's a senior associate in our corporate team here at LegalVision, and we also have Matt, who is the director at Rise Accounting. So just before we begin, a little bit of housekeeping. You will receive the recording and these slides in your email. It's all also available on our YouTube channel along with the regular webinars that we do. There will be a Q&A at the end, so please do submit your questions throughout the webinar. And we do please ask if you could fill out the feedback survey at the very end. So with you guys joining the webinar today, you are eligible for a complimentary consultation here with us at LegalVision to discuss how we can help your business. To claim your complimentary consultations, just leave your contact details in the survey at the very end, or you can also contact us through our website. Great. Well, I'll pass over to you, Michaela. Thank you.
Thanks, Jay. So as you can see on your screen, today we'll be discussing 5 key areas of EMI option plans. So the first is just a general overview of what EMI option or what option plans generally are and why they're used generally in the startup area. Then we'll go through vesting, exercise, and leaver provisions in option plans. Matt will take us through some of the tax advantages of EMI option plans, as well as EMI qualifying conditions and compliance. And then we'll generally give you an overview of how you go about setting up an EMI option plan as well. So the first thing that we're going to discuss is what actually is sweat equity, because it's a term that's used quite frequently in the startup space, and you might have come across it, but not known what exactly it is. So it does refer to an idea that founders and early contractors, advisors, employees, or anyone else that's working in the company of startups can be rewarded for their efforts, or what we refer to as sweat, with an ownership interest in the company. Now, that can be offered instead of a cash payment, given that startups might not have large amounts of cash to be able to pay high salaries. So it is an idea that your work the work that you put into the business will be returned with an ownership interest in the company, which is the equity. And a common way to do this is by offering options in a company instead of shares. And we'll go through shortly why that is a better option for a lot of companies. Startups will often use it as a form of remuneration because they won't usually have large amount of cash to be able to pay an employee or a contractor what other businesses in the market might be. And by giving key employees an ownership stake, it is seen as an idea that it incentivizes those employees to work towards the growth and the profitability of the business. So you could also say to an employee that you're offering them a chance to be a part of something that has great potential, and that might then disrupt the industry that you're in. Before you get started down the sweat equity road, though, it's essential to understand what the legal requirements associated are, as well as how you might be best to structure that sweat equity arrangement from both a legal standpoint, but also from a tax standpoint for both the company and the individual as well. Now, firstly, I'll just go through a bit of an introduction around what an EMI scheme is. So when offering an employee equity in the company, you could do that by issuing either them shares or options. Now, generally, we recommend that a company doesn't offer shares to employees or contractors, as it's usually difficult to buy those shares back if an employee does leave the company. And generally, with shares, they won't need to earn those shares over time in the same way that they might need to with options, unless the shares were subject to some sort of vesting arrangement. Now, we refer to an employee share option plan, also known as an ESOP, which is an alternative way to offering shares to someone working for the company. And it's actually a right for an employee or contractor to have the right to acquire shares in the company in the future. Now, that right itself is called the option. Now, as you can see on your screen, one option equals one share. So if you offer 100 options, that would mean that the individual will potentially be able to receive 100 shares in the future, provided certain conditions are met, which we'll go through shortly as well. The company will also have what we call an options pool if they go down this route. And that might, for instance, be 10% of the capital in the company from time to time can be offered in options to individuals working for the company. There are different types of option schemes that you can look to go down the path of. So there's what we call discretionary, and then there's also all employee plans. So all employee plans are those that will apply to all employees in the company regardless of the conditions. Whereas today's webinar is actually going to focus on discretionary plans, which are those that only apply to a small number of key employees. And in particular for this webinar, we'll focus on enterprise management incentive, so EMI schemes, which is a type of tax beneficial option scheme. Now, EMI schemes are specifically targeted at small, higher risk trading companies, so usually startups. And for that reason, the eligibility requirements are also quite strict for both the company and the individual employed by the company. And Matt will take you through later some of what those eligibility requirements are. So the first thing I'll go through now is vesting, exercise, and leaver events, which are sort of the three main aspects of an EMI scheme, and how those operate and what they mean. The first thing is vesting conditions. So options are generally granted on the condition that they need to be earned. Now, there's two types of ways that you can structure that earning requirement. The first is time-based vesting, and that is the most common type of way that vesting is structured. And it's just where options will vest over time based on specific time requirements. So one of the most common market standard ways that you'll see is a 4-year vesting period with a 12-month cliff. Now, what that means is, say, for instance, you offer someone 100 options in the company. After 12 months, that individual will have vested 25 options, and subject to any sort of exercise requirements, they might be able to exercise those 25 options into 25 shares. The remaining 75 options will vest over the next 3 years, and usually the vesting will speed up. So it might be quarterly that those 75 options will then start to vest. The other way that you can structure it, though, is what we call milestone-based vesting. And this is where there's certain performance milestones that need to be met in order for the options to have vested. Now, generally, we recommend against using milestone-based vesting unless the conditions for the milestone can be quantified. So, for example, that a set annual turnover of the company has been met in the last 12 months. That's the reason that it needs to be quantified is that it ensures that no disputes can arise over what the condition if the vesting condition has been met or not. But most commonly, you'll see people will just go down the time-based vesting because it's the easiest way to prove if the vesting condition's been met. The next thing to think about is exercising the options, so when they can actually be exercised. Now, they can usually be exercised during what we call an exercise period, which is after the options have vested, as we've just discussed around vesting, but before they have actually lapsed, and that there are certain lapsing conditions which will be under the plan rules. Another way to do it is when a trigger event occurs. Now, that will depend on what's set out in the plan rules for the company, and each company might go down a different route. But a trigger event is usually if there is a leaver event for the individual, so if they leave the company, or there has been an exit for the company. So that might be if there's a sale of the business or a sale of all of the shares in the company, that it then triggers that person being able to exercise those vested options. Now, to exercise an option, once the vesting conditions have been met, the participant will usually need to pay the exercise price. And Matt will go into further detail shortly on how that exercise price is usually valued. And then they'll also need to provide an exercise notice, generally, but it will depend on what's in the plan rules as to what the conditions are. Once the individual has exercised their vested options, then the company will go through the process of actually issuing the shares, updating Companies House that the shares have been issued, all of that normal process. Generally, we do recommend that the companies only allow participants to be able to exercise on what we call that trigger event, which was what I was referring to earlier. So that's where an individual leaves or if there is an exit, particularly if the company is going to be offering options to a large amount of people, so a lot of people. The reason for that is it will become quite administratively burdensome on the company to be having to issue shares quite frequently if you're offering options to, say, 20 key employees. So generally, it will be a trigger event, meaning that even if the option has vested, that person won't be able to exercise that option and become a shareholder until either they have left in good circumstances or until there is an exit event of the company. So then that actually moves us into when would someone be classified as a leaver, because that is one of the conditions of that trigger event. Now, leaver is just generally someone who stops working for the company. So the board will usually be given discretion over what they want to happen when a participant becomes a leaver. Generally, vested options and unvested options will be dealt with differently. So with vested options, good leavers may be allowed to keep these, and it will depend on what's under the company's plan rules for what happens in these scenarios. But it's usually if someone's a good leaver, they'll be allowed to keep them, and then there'll be a certain time period in which they can exercise their vested options into shares. So for instance, it might be that a good leaver can exercise vested options within 14 days of a leaver event. If they're not a good leaver and the board doesn't determine that they can exercise their vested options, so it's what some people refer to as bad leaver events, then the options will generally lapse. The other side of that is the unvested options. So they will just generally lapse whenever an individual leaves, because those options haven't actually been earned yet. So all of them will just essentially lapse. So in the example that I gave earlier, if there were 100 options offered and an employee had left after 12 months and they're classified as a good leaver by the board, then they'll likely be able to exercise 25 vested options to receive 25 shares, but the remaining 75 unvested options will just automatically lapse and they won't be entitled to those. So I'll now hand over to Matt. He'll go through some of the tax advantages of EMI options and the HMRC reporting obligations.
Perfect. Thanks very much, Michaela. So yeah, in terms of kind of the tax advantages of EMI options, there's two sides to it. I'm sure the vast majority of you on today's call are an employer, but also it's really good for you to understand what the employee tax benefits are, such that when you are selling this or trying to incentivize the individual to come on board and provide them with EMI options, you at least know what those tax implications can look like. So as Michaela mentioned, the first part, once you set up the EMI scheme itself, you're then going to grant the options to that individual. At that point, from an employee perspective, there is no income tax nor national insurance contribution payable, okay? Likewise, when they exercise those options, again, there is no income tax or national insurance, which is payable by the employee itself. So again, you know, that's a huge, obviously, saving for the employee and obviously very advantageous from a tax perspective. The only point at which where tax does apply is upon the sale, okay? Now, when a sale occurs, the type of tax that the employee will therefore have to fall under will be determined as to how long those shares or the options have been granted to that individual. If the shares have been granted for less than 2 years, capital gains tax would apply. So if you're a lower rate income taxpayer, it would fall at 18%. If you're a higher income taxpayer, it would fall at 24%. Now, if you've had those grants for more than 2 years, you've been granted those options for more than 2 years, you would then qualify for what's known as business asset disposal relief. And obviously, in April of this year, that was increased from 10% to 14%, which is obviously still far more favourable than falling under capital gains tax. Now, in terms of kind of on the employer side, again, national insurance contributions are not payable. So again, another benefit for yourself. But another benefit is corporation tax deduction. So the point at which the employee decides to exercise, at that point, they have therefore received their shares. So just in the same way that, so from a HMRC perspective, they're actually looking at it and saying, okay, well, there's effectively a share-based gain. So it's effectively a form of employee remuneration. So the same way in which you would apply a salary or a bonus, that would be a cost to the business. So the difference between the market value and the exercise price at exercise, you would therefore be able to make a corporation tax deduction and obviously reduce your corporation tax. So what I wanted to do now is kind of almost bring to life a work example. I'm a little bit more generous than Michaela. I've given 10,000 shares. But let's take an employee, Emma, of a new SaaS startup, okay? And she's going to be granted 10,000 shares. Now, those 10,000 shares, they can vest over a period, and let's take Michaela's example of over 4 years. And when we're producing that valuation, we determine that the exercise price is £2 per share. Now, when those shares do vest or exercise, the market value at exercise is £10 per share, okay? Now, when those, let's say Emma has therefore been an employee at the business for a number of years, let's say more than 2 years, and therefore she has those shares before the sale of the company. So now we know that she would qualify for business asset disposal relief. Now, again, she exercised those shares at a value of £10 per share, but when the business goes to sell, the company is valued at a price such that it's £25 per share. So what is Emma's gain? So it's the sale price minus the exercise price, so 25 minus £2. That is a £23 per share gain for Emma. So obviously being very generous with the 10,000 shares, that is a total gain of 230,000 for Emma. So how does this then benefit both the employee as well as the employer? So we've already determined Emma's held those shares for more than 2 years, so qualifies for business asset disposal relief, which, as we know, the rate is at 14%. So the tax due under business asset disposal relief would come to £32,200. Now, if you compare that against corporate capital gains tax, assuming that Emma is a higher taxpayer, at that rate of 24%, she would have to pay £54,480. So obviously there's a tax saving of 22,280, which I think we can all agree is a large sum of money and quite clearly a big benefit to the employee. Now, from an employer's perspective, when Emma exercises her shares, the company can also reduce the corporation tax, but it's only at the point of exercise. You can only use it once, and it can't be used again at the point of sale. This is purely between the difference of the exercise price, the grant price, and the market value at exercise. So we determined that the exercise price within the EMI option scheme is £2. And the market value per share when they were exercised is £10. So the gain per share is £8. So upon exercise, Emma's benefit is £80,000 as in value of shares. So we can almost deem that as a remuneration. So therefore, the calculation would be assuming that the business were paying 25% corporation tax. It would be 80,000 times 25%, and therefore that's a £20,000 tax deduction. Okay. So hopefully that kind of brings it to life. So we've understood what the tax implications are. Now it's about understanding, okay, well, who actually qualifies? Again, to Michaela's point, it is purely based for kind of the SME markets, the startups and the scale-ups. They want, and therefore the qualifying conditions are quite strict. Now, for companies, I think it's pretty straightforward. You need to be actively trading. You need to have a permanent establishment here in the UK. What does that mean? That means you need to have employees, a warehouse, whatever it may be, a physical location with employees. Fewer than 250 full-time staff, no more than 30 million in gross assets. Another point to note, if you are a business which is looking to roll out multiple EMI schemes across a number of years, you can't have more than 3 million worth of unexercised EMI shares effectively in operation. Okay, so you need to make sure that if you do have a number of EMI shares, if there are a batch which are unexercised, that value has to be less than 3 million. Okay, it's a very small point, and I can't imagine it will affect many of you on today's call, but it's just mindful if you're looking to roll that out in the future. You can't be carrying out any excluded activities, which I'll touch on the next slide. From an employee perspective, you must be an employee. You must be on payroll, so going through PAYE. I would imagine the vast majority of you are looking to just provide options to, as Michaela mentioned, kind of early employees who are going to play a key role within the business. They're putting a lot of time and effort, but as per the qualifying conditions, they should spend at least 25 hours a week. I'm sure a lot of them are doing more than that, or 75% of their working time. Okay, so that's kind of the minimum requirements. And then the last point, we often see that businesses will, there may be an initial founder who then finds a co-founder, and they want to bring them in and give them a small piece of equity initially, but they want to be able to see from that new co-founder that they're going to be, you know, with the business for a long period of time, and they may only want to give that co-founder additional shares over the next 3 to 4 years, let's say. Now, obviously, if it is a co-founder, for example, it could be a sizable equity stake within the business. The thing to keep in mind is that that individual can't have more than 30% of company shares. Okay, so hopefully that gives you a bit of an idea as to what the qualifying conditions are. In terms of the excluded activities, we've actually got some in terms of businesses that don't qualify. As I said, it is focused towards the SME space. So large companies, anything more than 250 employees, anything more than 30 million in gross assets. PLCs, this doesn't apply to them. So quoted listed companies. Likewise, a holding company, they don't qualify. You need to be actively trading. You need to have employees. There needs to be ongoing business. And then in terms of the excluding trading activities, so things like dealing in land or commodities or you know, financial instruments. Likewise, banking, insurance, leasing, if you're doing car or van leasing, whatever it may be. And likewise, accounting or legal services. Actually, for most professional service-based businesses, EMI schemes isn't applicable. Typically, HMRC want to see that there is an element of risk. These businesses are investing into research and development, and ultimately, off the back of that, that's why they're giving these individuals a further tax incentive to join your company and ultimately have a larger gain off the back of it. So then ultimately, now we understand who can qualify as well, is then kind of looking at, okay, well, what does the process look like? Obviously, part one is setting up the legal framework, which I'm sure Michaela will now kind of run through with yourself.
Yeah, thanks, Matt. So I guess the first step, usually we see clients when they first are looking to do this, they'll book in an initial call with us just to generally discuss how it all works, as well as the eligibility requirements generally as well. And in that initial call, that's where we'll usually go through the process of what they need to be doing in terms of the exercise price with HMRC, which Matt will talk about in a second, but also what documents are involved, whether they meet a lot of the eligibility criteria, and just answer any questions as to how the process works itself. One thing I did want to mention before I get into more of the legal framework is a lot of clients that we see, they will be offering to employees these options. And as Matt mentioned, in order to qualify for the tax benefits and the EMI tax benefits, the individual does have to be classified as an employee of the company. But we do also have a lot of clients that come to us and say, well, I want to set up an EMI scheme, but I want to offer to both employees and contractors. Now, during that process, they can do that, but it's just they need to keep in mind that if you're offering to contractors, they won't be eligible for the same tax benefits, as well as the company won't be eligible for those like corporation tax deductions as well. So in terms of that process as a whole, it usually will be, and I'll go through in more detail as to how the documents work, but usually you'll have your base plan rules, and then you'll have an option agreement, one for employees that are eligible, and then you might have an option agreement that you use for contractors who aren't eligible. But when those circumstances arise, we always recommend that the individual go gets their own tax advice for what it means for them personally as well. So that's generally the initial consult that we'll have. Then the first step for the company will be to ensure that the tax relief will apply. So it'll be looking through that eligibility criteria. And then it's also recommended that the company goes and gets the share price agreed with HMRC. And that's where your accountant, so for instance, Rise, can come in. So Matt, when a client comes to you asking for a HMRC evaluation, are there certain timeframes that you recommend to them, things that you recommend that they look out for?
Yeah, absolutely. Ultimately, especially if there's kind of an upcoming fundraise and you want to get the EMI set up ahead of that, definitely something to look out for. But in terms of the actual the valuation itself, in order for you to actually access EMI tax relief, you have to have what we call a defensible share valuation, and that has to be agreed with HMRC. So when we're looking at it, there's going to be two figures that we're working towards. The first is called UMV, which is the unrestricted market value. So if you were to go out to market today on the open market and try to sell the business, effectively, what would someone be willing to pay for those shares? And then the second value is called AMV, which is typically the exercise price. That is the adjusted market value. So the value of the shares when you're taking into account different restrictions. So when we're looking at the shareholders agreement, are there any preemption rights? Is there kind of any restrictions in terms of no transfer without consent? It could be the case that the founders get first opportunity of buyback before you're allowed to sell the shares to anyone else. So they're the kind of two key metrics which HMRC will be effectively signing off. Now, when we're supporting clients with that valuation, we're typically looking at latest set of financial information, current cap table, and what type of share classes you may have. Have you fundraised recently? Is that going to help us with an indicative valuation? Obviously, the details around the articles of association or the shareholders agreements. And ultimately, as well, the forecasts and financial projections that you have, that's going to help us determine what that final valuation is. For those of you who've probably read into it a little bit more, we are trying to achieve, the largest discount possible. Typically, to do that, we will use a discounted cash flow method, and then obviously looking at the different restrictions that are in place, whether there's SEIS or EIS eligible for previous rounds or upcoming rounds. That's certainly something that we'll take into consideration. Now, from a timeline perspective, once we submit that valuation to HMRC, typically it will take 4 to 6 weeks, and they are pretty set on that, unlike with R&D tax credits, if any of you have gone through that process of late. And then once that's approved by HMRC, there's then a 90-day period for you to then grant those options to the individuals. And as I mentioned, the exercise price is then kind of the AMV value to avoid any income tax implications.
Yeah, so I think just moving, I guess, adding on to that, whilst you're going through the process of getting the exercise price approved by HMRC, that's also the same time where your legal advisor would usually be recommending that you're setting up the documents, because obviously there is the 4 to 6 week process that HMRC will take in order to assess that value. But then once that is granted, you do have that 90-day timeline. So it's a good idea that at the same time you're getting the legal documents in place. So it's basically ready to be offered as soon as that price is approved. Now, in a scheme, that there's certain documents that are involved, which your legal advisor can help you prepare. But the main ones are the base plan rules. So these are the terms and conditions which will apply to the entire plan. They will also apply to every single person under the plan that are offered options. They will detail how the plan's to be administered, so which is usually by the board, what the vesting requirements are, what happens when someone wants to exercise, what happens when someone leaves. So all of those things that I mentioned earlier. Then you'll have your option agreement, which is in addition to the plan rules. It is subject to the plan rules, but the option agreement will be able to be tailored for each individual participant. So as I mentioned earlier, you could have an option agreement for employees, and then you could also have an option agreement for contractors who aren't eligible for the EMI tax benefits. That option agreement can also be tailored to override some of the plan rule requirements. So for instance, if you use the time-based vesting under your base plan rules, but then for one particular employee, you also wanted them to actually meet certain milestone-based vesting, so that there had to be certain targets achieved in 1 year for them to be able to exercise those options, that can be tailored into their option agreement as well. Then the third stage is the approval documents. So the actual corporate governance documents that you need in order to actually implement the plan, approve the plan, but then also to administer it going forward. So generally what you'll see there is you'll have a board resolution that will need to be passed when you're looking to actually approve the plan. Then the board will have to resolve each time that someone is offered options under the plan. And then you may also need the shareholders to resolve certain things if it hasn't been approved already, for there to be a share plan implemented by the board. It really just depends on the company's articles of association and shareholders agreement, if there is one, and what requirements there are under those documents in order for the plan to actually be adopted. Now, following the plan being established, you've also then offered options to certain individuals under option agreements. There will also be ongoing HMRC reporting requirements that you need to ensure that you're meeting. So Matt, do you have any comments on what those reporting obligations are that are ongoing?
Yes, so of course there's ongoing compliance, and yeah, there's two key points really to take away from here. So once that valuation has been determined and agreed by HMRC, you have the 90-day period. Once you have granted the options to the employees, you then have a 92-day period to submit the grant notification via the ERS portal, which again is something that we can certainly support you with. And lastly, you then have to do an annual return. Okay, so an annual return, think of it somewhat similarly to a confirmation statement. It's like updating the administrative tasks that are involved with an EMI option scheme. So were there any exercises throughout the year? Even if nothing's happened, you still need to produce a nil return. And again, these are going to be due shortly after the tax year. The deadline is the 6th of July every year. So following the 5th, 6th of April financial year end. And yeah, that's kind of the ongoing compliance, and it's certainly something that we can help you with. All right.
Amazing. Thank you so much, Michaela and Matt. Lots of very useful information there. And this concludes the main part of our webinar now. So if you guys didn't get a chance to earlier, do feel free to scan the QR code on your page right now. This is for the startup manual, full of very, very useful things for your startup. Okay. So you may also be interested in our next webinar. We do these very regularly, like 2 to 3 times a month. So you can have a look at our YouTube channel, our previous ones. But the next one's actually this Thursday at 11, and it's around intellectual property strategies for your tech startups. Okay, so feel free to register using that link or check out our website as well. So while you guys submit all your questions for the Q&A in the moment, I'm going to take a moment just to tell you about being a LegalVision member. So our membership gives you access to a full team of specialist lawyers for all your business as usual legal needs. It's basically like having an in-house legal counsel, but at a fraction of the cost. So the kind of things that we can assist you with are unlimited document drafting, all your consultations, or IP protection, trademark registration, and lots more, all are guaranteed at very quick turnaround times at affordably monthly cost. So basically, when you do become a member, you just wouldn't need to worry about the cost of lawyers again, and we will take care of all the business as usual legal work while you focus on running your business, doing something that you hopefully enjoy. Yeah, and we can just take this off your hands. If you do happen to be part of an in-house counsel at the moment, then we do also have something designated for you guys, which we would call a desk extension, where we can support you in managing your high volume business as usual legal tasks. So remember that you are qualifying for a free complimentary consultation. So in order to do that, just fill out your details at the survey at the very end, or feel free to do that on our website as well. And then we can have a good chat about ways how we can support your business at an affordable monthly cost. Also, feel free to reach out to Matt. You've got his contact details there. So, take a picture, take a screenshot. You'll have the slides later in your emails as well. So LegalVision works with Rise Group for things like EMI. So feel free to contact either one of us to support you with this. They can also assist you with all your general accounting needs, tax accountings, and of course the evaluation side of things. So what I'm going to do is I'm going to hand back over to our host. You'll get a poll question pop up now, so please just answer that. And yeah, I'll hand over to Michaela and Matt to answer some of the questions that you guys put in. Thank you.
Thanks, Jay. If you can submit your questions now, I can see there's one or two that have come in, but if you submit them now, we can also look to answer some more before the time is up. So I think one of the first questions is around vested options for good leavers, which may be allowed to be kept. Can you clarify what typically constitutes a good leaver versus a bad leaver? And does the board have complete discretion on the classification? So I think this one's probably more for me. In terms of the good leaver requirement, it's usually set out in the plan rules for the plan itself. Generally, what we see in terms of the plan rules that I've seen, good leaver will be quite a limited definition as to what classifies as a good leaver. So it's usually if someone passes away, if they're incapable of managing their own affairs, or if they're dismissed or terminated, or they resign for any reason which isn't associated with, say, gross misconduct, fraud, dishonesty, breaching their employment contract. So it is quite limited to that. If the individual doesn't fall within that good leaver definition, then the board will have discretion over whether they're entitled to exercise their vested options or not. So in terms of the requirements to be met to be a good leaver, that's usually quite set under the plan rules. Now, obviously, plan rules can be amended depending on what the company wants to do, but the good leaver definition is usually quite set, and then the board will have discretion to step in if that person doesn't classify as a good leaver and to determine what they want to do with those options. So I think that probably answers that question. Another question is probably one more for you, Matt. what level, so I think this is when you were talking about the discounts earlier with HMRC on the exercise price. So what level of discount between the UMV and AMV is HMRC typically accepting? Is there anything you generally see for that?
Yeah, no, great question. So typically in the past, we have seen discounts as high as kind of 95%. I think probably over the past year and a half, we've certainly seen more pushback from HMRC in this regard. Ultimately, it really depends on what restrictions are in place. Ultimately, the more restrictions, ultimately, the lower the potential value, or lower potential, the higher the potential discount. So I would say that, going into this, if you can have somewhat of an expectation that it will fall anywhere between kind of 30 and 70%. Obviously, if you are SEIS or EIS eligible and you have the advance assurance, that is going to help as well. But yeah, I think, I wouldn't go into this thinking it's going to be as high as 95%. That is incredibly rare to see these days. I would typically aim between kind of 30 to 70%, but obviously it's on a case-by-case basis, but hopefully that gives you an indicative range.
Yeah. Is there a reason why you think, Matt, that HMRC is, I guess, cracking down on that a bit more? Is it because they're more common, or is there any sort of reason for that?
I think we'll all be in agreement that there's an agenda, obviously, to increase and get more tax into the government, higher taxes into the government. Ultimately, look, it's quite a significant. If you are discounting to 95%, obviously that's a massive discount. And is that really, can you really justify that significant of a discount? Probably not. At 95%, you're effectively saying the business has just started out, when actually it could be 2 to 3 years down the line. So there has to be some level of nominal value initially that the employee should be willing to pay. And then after that, they're then seeing obviously the benefit between, and they're also incentivized between what that exercise price is when they receive it to what it's going to look like at the end. They need to incentivize growth. Ultimately, as an economy, we're going to be far better off if the business itself does well, rather than just that single employee. So obviously creating jobs and everything else by incentivizing growth, that's certainly on the government's agenda.
Yeah, no, that makes sense. I don't think there's any other questions that have been submitted at the moment, so I'll just give it a little bit of time in case someone wants to ask another question. But I think that's pretty much it. So I think that will probably wrap up the webinar if there's no other questions to be asked. But as Jay said, there is the UK, oh, there you go. Jay, do you want to jump in and go through that?
Sure, thank you, Michaela. So I guess this is all we have time for today. Like I mentioned, do take advantage of the complimentary legal health check. It's just a good 30-minute appointment, having a chat, understanding your business, and then we can help you identify gaps in your legal work and explain how we could potentially assist you. Just making sure things are done simple and affordable for you. There will be a survey at the end. So while these webinars are free, we would really value your feedback and appreciate you taking the time to fill that out. It'll only be about 30 seconds. So feel free to leave your details if we didn't answer any questions, you wanted some assistance, or if you want to learn more about how our membership can assist you. But thank you everyone for joining us today, and we'll see you again at the next one.
Perfect. Thanks very much.